Hello, I'm Simon Lambert from This Is Money. Investing delivers better returns than cash over time because investors run the risk of losing money. But that doesn't stop stock market storms keeping them awake at night when they come along. So what can they do to keep calm when those storms arrive? And do they even represent a buying opportunity? I'm here with Tom Stevenson of Fidelity Personal Investing to find out. Hello, Tom.
Hi, Simon.
So, when a stock market falls, it's always concerning for investors. But how worried do they need to be?
You're right, no one likes to lose money on their investments, but I think an important point to remember about stock markets is that short-term volatility is the price that we pay for the long-term outperformance of the stock market. So when we have corrections, we had one recently, the market fell by about 10% from peak to trough. You have to remember that these things happen and markets tend to bounce back from them. We actually ran some figures on this going way back to 1950, and we found that the US stock market had fallen by more than 13% in a 3-month period on 24 separate occasions. But when we looked into it, on 15 of those occasions, the market subsequently bounced back by more than 20% in the following year. So yes, markets do fall, but they tend to bounce back again.
If you're an investor and a storm arrives, should you be looking at it as a stock market storm and a buying opportunity then?
Yes, I think that it should be seen usually as a buying opportunity. So as I say, we've had a correction recently of 10%, and clearly, by definition, the market is 10% cheaper than it was at the peak of the market. An important thing to remember is that missing out on the best days in the market can really damage your long-term returns. So again, we ran some figures on this. We found that someone who had been invested from 1994 to date over a 20-year period and stayed invested throughout that period would have made a return of about 300% on their money. However, if they'd only missed out on the 10 best days in that 20-year period, their return would have been about 100%. So they would have lost 2/3 of their return just by missing a handful of the best days in the market.
Many investors will look at those stock market charts and they'll think, well, if only I could have bought in at the bottom and sold out at the top. But are attempts to time the market too risky for most people?
Yeah, it is notoriously difficult to catch the tops and bottoms of the market. It may sound a little bit cheesy, but we have a saying, we say time in the market is much more important than timing the market. And what we mean by that is that it's leaving your money over the long haul is the way to generate good returns. Trying to catch the tops and the bottoms and almost certainly missing those tops and the bottoms is a good way of reducing your returns quite considerably.
Stock markets have had something of a fine run over the past 5 years from the post-financial crisis low. So do shares look expensive or cheap, do you think?
You're right. I mean, shares have been rising for about 5 years now. Now, our view is that bull market, as it's called, a rising market, has some way to go yet. But in terms of valuations, which ultimately drive the performance of the stock market, it's quite varied. So, for example, in Asia, emerging markets, shares look quite good value. In the UK, they look reasonable value. In the US, they look a little bit more expensive. So I think what that argues for is making sure that you have a well-diversified portfolio so that you capture the differing returns all across the world.
And if you are a long-term investor who's decided to stick in it and ride those storms, what are the best ways to spread your risk?
Well, I've just referred to one of the most important ways, which is diversification, because no one really knows where the returns are going to come. So I've talked about geographical diversification, but also diversification between different types of asset is important. So for example, in this latest correction, money was taken out of the stock market, but a lot of it found its way into the bond market. So if you'd had a balanced portfolio, which included both shares or equities and bonds, then you'd have felt much less of the pain than if you'd all been in equities. So diversification, very important. I've talked about not trying to time the market. Investing regularly is the best way of ensuring that you don't succumb to the temptation of trying to time the market. If you just invest month after month after month, then you'll avoid that risk. And I think the third point is to focus on quality. Ultimately, stock markets are driven by the earnings of companies, and high quality companies will generate high quality earning streams.
So patience, luck and some good research, that should see you through.
It should do.
Thank you very much, Tom.